right. Good morning, everyone, and welcome to today's webinar. I am Chesco Cordero from Insightful Accountant and your host for today. And before we actually start, I want to go ahead and ask our question of the day, just as everyone's kind of coming in and just settling down in front of your computers, your phones, or your tablets. And for those already with us in the room, you can chime in if you want to. Okay, so question of the day. If a cassette or a disc would have gotten stuck in your car's player and it was stuck in a loop, what song do you think would be playing?
Oh, that's a good one. Are you asking me that?
Yeah.
Oh,
Yeah.
anything by Old Dominion. I've never had any song by Old Dominion. I can be a fan girl, right? I could just be a groupie and follow them around the world.
Yeah. No, that's great.
And I'm sure they would catch on to it after a while. They go, "Who's that big bearded guy we see in every
We
city?"
every single show. He's always here. I don't know why. Well, it'll probably be for me. I got stuck in a car. Probably be Waterfalls by TLC. Probably get stuck right there.
All right, I can see
Jam
that one.
out all the time. And at this point, I probably already know the rep, so I'm good. All right. Okay, good morning, everyone, and welcome to today's webinar. Again, I am Chesco Cordero from Insightful Account and your host for today. Now, in this cash flow mastery talks, we'll be talking about effective cash flow forecasting, planning for future growth and stability with the amazing Mike Milan. Now, I'll hand this off to Mike in just a little bit after I cover a few of the housekeeping items. Now, there is no CPE for this as it is just a 30-minute webinar. And if you have any questions, please enter them in the Q&A panel and be specific. Don't just say, hey, what you mean? You got to say, hey, Mike, what you mean by you would follow that band around the world? Mainly because he might not get to your question right after you put it in there. And we'll also be sending you a copy of the slide deck and the link to the recording after the webinar. And it's also going to be up on our YouTube channel within about 24 hours. So if you want to go check that out over there, along with many other webinars that Mike has done in the past that might be of interest to you as well. I'll be putting that link to our YouTube channel into our chat. And also don't forget that we have many webinars for you every month, whether you're interested in practice management, marketing, everything tax, or all things QuickBooks or cash flow like this one. Insightful Accountant's got something for you. And you can check out all of our webinars that are available to you over on our educational webinars page on our site. And don't worry, I'll also be putting that link into our chat. And speaking of webinars, mark your calendars for Insightful Accountant's Future Forward Integration and Workflows on May 21 to 22, and get ready for 8 exciting webinars over 2 days, where each is eligible for CPE certificate. So don't miss out on this opportunity to enhance your skills and stay ahead in the industry. Now, if you haven't subscribed to our newsletter yet, join the tens of thousands of accounting professionals who rely on Insightful Accountant to keep them up to date on the news and updates impacting today's accounting professional. Now, I'll be rolling out all those links and the copy of the slide deck throughout the webinar in case you might have missed it the first time I put it in there. So watch out for that in the chat. And Mike, that's actually it for me. Welcome and thanks for being here.
All right, all right. Hey, Jessica, thank you very much. Live from San Antonio, it's Cashflow Mike, the home of the cloudy eclipse. That's right. I didn't see the eclipse at all. It got dark, but I saw clouds. So everybody else had a wonderful experience with it. I hope you did. But myself, yep, I saw the clouds and it got super dark. We're going to talk about forecasting more and more and more. I'm having discussions about forecasting. So I want to kind of lead with this. If you don't, if you don't know how to do it, there's really 5 distinct steps, and most people stop at 1. Some people will do 2, but there's right 5 distinct steps. And I wrote a 32-page PDF called Forecasting by the Numbers. And if you want that, email me at mike@cashflowmike.com and I'll send it out to you. It's a big file. So if you want my step-by-step, how do you do forecasting by the numbers and not miss a step? Well, get that PDF from me. So why am I doing this, right? One of the things I've loved about the relationship with Insightful Accountant is they allow me to come on to fulfill my mission of helping eliminate cash flow as a reason that businesses fail, right? That's one of the reasons that I'm trying to do this. We have 18,000 bankruptcies a year. Some of those, a lot of those have profit on the books. How are they going bankrupt if they're making money? That's one of the questions we want to answer for all of our clients, especially when they say things like, you told me I made money this year. How come I don't have any? Those are the types of questions that we're trying to answer. So how do we do this? How do we do this forecasting by the numbers? And before I begin, I'm going to ask a favor, right? And I never do this, and I haven't earned it from you yet, but I'm going to put in the chat this link. Next week, I'm going to New York. I got selected as a finalist for Best Brand for Entrepreneurs, which means I'm an entrepreneur champion helping businesses stay open. If you think that I've been doing that over the last 9-10 months of doing these insightful accountants, I'd appreciate your vote. Doesn't cost you anything. It's a great little newsletter you get. It's by Seth Godin and Ramon Ray, if you know those numbers, but I put it in there. If you'd be kind enough and you think I earned it at the end of this, give me a vote. For next week, I'll be in New York City to hopefully accept the award. So let's talk about the first step, right? The first step that I always start with, though, is transferable value. Now, that's not a concept I'm going to talk about today, but making sure that we plan to have enough money for ourselves, transferring value from our company to us. What happens at the end of the year should be a planned event. Not surprised. We shouldn't be surprised on what happens at the end. It should be a planned event, and we start with what we're going to do. Now, the technique that I use is called common sizing. What common sizing does is it allows, expenses or liabilities or assets to expand or contract based on if sales increase or sales decrease, expand or contract. And common sizing is really holding a couple different key, ratios or key percentages in place. In this case, I always say that gross profit is the most important number on an income statement. So I always hold that solid. My pricing strategy, what I'm trying to achieve, even if it's a blended gross profit percentage, I'm trying to get 76%. So in 2021, when we did 2.9 million in sales, I got 76%. So in 2022, in this case, when I'm trying to grow my business, do a little bit more, I want to do 76%. So it allows gross profit to increase. But when we grow, sometimes it costs us a little bit more money because we have to add an employee. We have to add some expense. We're actually going to allow expenses to grow too. I'm going to try to hold those close to 56% of sales. So that's kind of the first thing. But if you look at this is the annual view. But this is where I always start is with the annual because it gives me the basis for figuring it out. What this lacks is reality. I can't really do anything with this. This is just saying, here's the basis. We're going to try to sell $3 million. I'm going to try to have about 323,000 at the end of the year. If you notice, you're like, oh, those aren't 3 million. Those aren't 323. Well, I just dropped the zeros off for easier math. That's one of the things I do here. But the next thing I'm going to do is say, let's look at what happens through the year, because it isn't like we can just peanut butter $3 million across 12 months, take 3 million divided by 12 and spread it across. And I see that happening a lot, but that's not the way a lot of our businesses work. What we have generally is some type of seasonality. We got bigger months or smaller months. And what I do is I go back, if I can, over 2 to 3 years. If I can't, I just go back to last year. But if I got 2 or 3 years, I'm going to try to determine how much of this 2.9 million came in January or August or December and give them percentages. Because when I do that, I can now take my forecast and divide that $3 million by these percentages and create, in this case, look at this, the seasonality. In this business, you can tell that most of their money is going to come in during that May, June, July, August, September timeframe. So this is one where we can see it visually before anything else happens. We can see that sales are going to take place over the course of the summer. But that also tells us that we're going to get a lot of money on the back end of this because all the sales will be collected in the form of AR, or if it's cash, we need to then stockpile some cash going forward into the next season, right? So this is kind of starting to show you when you'll have money and when you should be saving money for the future. So I'll take this and I'll just show my client. And if I got 2 or 3 years, I'll overlay them on one chart. And when you overlay them on one chart, you can start to see patterns happening year over year. Like in the bar and restaurant business that I had, I could tell around Mother's Day, it would go up. Around 4th of July, it would go up. St. Patrick's Day. There were certain times of the year I could see spikes in my revenue because I'd kept that type of record. All right. So when we put it together, this is kind of looks like this shouldn't look unfamiliar to anybody on the call, right? This is just a pro forma income statement. Now, when I use the word pro forma, it should mean something to you. If you hear somebody say that, you got to know instantly there's one question that you should be asking is, what did you leave out? Because pro forma means that we're not going to include any one-time cash expenses. Pro formas are used to test business viability. Does this work, right? If I sell this much and spend this much, am I okay with how much is left over, right? At the end. When we break it out, if you notice, it isn't peanut buttered across, spread across. It's actually broke out by the percentages we calculated on the beginning. In my course, A Clear Path to Cash, I give you the spreadsheet that does this for you automatically. It takes your annual and does this for you. But what we've done is we've broken it up 3, whatever, 25. But you can see most of the sales are coming in over the summer, like we kind of predicted in the previous slide. But look below, look at the net profit. This is our first indication that, oh my gosh, there's a problem. We're going to have issues in this company. And I always ask my clients, do you think this is normal, right? Do you think it's normal that we're going to actually going to predict and plan to lose money 1, 2, 3, 4, 5, 6, 7? We're going to lose money 7 months out of the year. Does that seem normal to you? In some cases, it is, right? This happened to be a building material wholesaler, which means builders and contractors would come in and they would sell them building material. Well, they did most of their business in the Midwest. They did most of it in the summer. So it made sense to them. Some people will ask, well, why don't they just close down? Why don't they just, why sit there and just lose, 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 lose? Well, because they still have fixed costs. They still have rent. They still had, utilities. They still had to cover some of their costs. So any sales helps reduce the loss. Plus, it's super hard. It's not like a pool where you got lifeguards you can just hire every season. These are employees that you've got to keep maintained because they've got training. You've got to retain them for just continuity in the business. So sometimes you have to stay open even through losing months because any type of gross profit you can collect contributes to your fixed expenses. And really that's what we're trying to do is minimize the losses. But right here, we should be having a conversation. Hey, listen, we're going to make most of our money profit, not cash, most of our money in the summer, which they already know. If I stopped here, which most people do, they say, okay, that's my forecast. I'm done. If I stopped here, it would not be real, right? It would not reflect the way my business actually works. It wouldn't reflect it, right? Because this is just saying, I'm going to sell this and spend this, and this is how much I'm going to be left over. But this is the exact situation where people get in trouble where they have no money. Well, I'm making money. I made $378,000. How come I don't have any? Well, because there's no cash budget. Some of the things that they do aren't reflected here. Some of the one-time cash purchases. Maybe we upgraded the computer. Maybe we bought a new truck. Maybe we bought some new other real estate. We use cash that was in the business. It just doesn't show up in the profit and loss statement. So you have to do step number 2, which is build a cash budget, right? And when we build a cash budget, instead of running things across, like on the income statement, we'll start in January and just kind of add everything up across. And that's how it goes line by line by line. You can't do that with a cash budget. A cash budget has to be worked kind of like a snake, right? I start with my beginning balance, whatever's on the balance sheet on December 31st, 2000, we'll say 21, should be the balance sheet or the beginning balance for January 1st, 2022, right? Unless we have one heck of a New Year's Eve party, we should have the same money. But I'm going to work this down, which is how much money came in, right? How much is available? And if you notice, I'm starting to think about my accounts receivable collection. So if I'm collecting in 30 days or I'm collecting in 60 days, I can't say that the sales I made in January is the cash I get in January. If my collection cycle is 60 days, I have to now project the sales I made in January, I won't get until March, right? 60 days later. So this is where it kind of offsets. Whereas if it was 60 days, the January 94 up here, I'm not getting now till March because it's 60 days later. So this is going to connect to your income statement, but actually show when you think cash is going to come in. Same thing with your cost of goods sold. You notice it's 23. If I go back to the income statement, there we go. I had 23 in, if I can erase that, I had 23 in cost of goods sold. I recognize the expense in January, but I didn't pay the invoice until February. I'm paying my bills on a 30-day lag, right? When my AP days is 30 days later. So I get the bill, I recognize the expense, I don't pay the bill for 30 more days. That's basically what this is saying. Back to that. Okay. So what I'm doing now is I'm working the cash down. This is how much came in. This is how much went out. Now, if you notice, it isn't just my expenses. And don't forget, take out the depreciation and stuff that you may have planned for in the income statement because it's non-cash. Nobody ever writes a check for it. But now I've got other things that I'm going to do that aren't included in the income statement. I've got some capital expenditures that I want to do. I've got some technology upgrades. I'm going to start buying stock back. But when you do this, you can start to plan when this should happen because you'll start to see your cash balance, your profit first, and then your cash balance second. So I've got 191 in cash in. I've got 197 in cash out. I already know month one, I'm going to have a deficit. I won't have enough money. So I may have to use my line of credit to cover some of the difference. So this is where I put in, hey, if we got to borrow from the line of credit or any other source, let's go ahead and plan for that. And what you'll see is you'll end up seeing when you'll have cash surpluses and when you'll have deficits. So in this case, we're going to be running deficits all the way through into the middle of summer before the cash collections here start to kick in, right? And that's when I'm able to make a surplus of cash and keep it in, and I'm able to pay off the line of credit. So what we're trying to do is project when we'll have cash so we can make better decisions on when we should purchase something. Maybe I shouldn't purchase, real estate and technology upgrades here. I should move that purchase out. But when you do that, you can see it and allow the numbers to dictate when you'll have enough money versus when you won't. And you'll make better purchasing decisions instead of just doing it when you feel like it. You can do it when you actually can afford it and not put yourself in a bad situation because this is cash, not profit. All right, so that's number two. First thing we did was we built a pro forma income statement. The second part was we built a cash budget to kind of see how money is going to flow in and out of the company. The third part, I doubt anybody does, right? I doubt anybody does. Oh, got a question maybe? Or no, I saw a couple different chats, sorry. The third part is forecasting the balance sheet. You're like, what? Nobody forecasts the balance sheet. Well, here's the thing about forecasting the balance sheet. It's going to help you understand if you need more money, right? There's a such thing as outgrowing your operation or outrunning your operation. This is when people get the big contracts and they go, oh, I'm in the money now because I'm in Costco or I'm in Walmart. Well, maybe you won't have enough money to keep up with the sales volume. Maybe you won't have enough money to purchase the materials or buy the labor. Like when I was in a hotel staffing company, I would have to determine whether or not if I took on a new city and maybe a bigger account, could I actually afford the payroll for 90 days while the account got up and running and went through the accounting system? I would have to make sure that I never ran out of payroll. So here's kind of where it starts. You're going to look at what the current balance sheet is. And believe it or not, I'm going to use the same technique, common sizing, which means no matter what the sales volume is, there's certain things that are going to maintain the same percentage. So in this case, I'm going to look at 2021 instead of 22, and we made 305,000. So I took the balance sheet and I split it. Instead of up and down, I just split it and went side by side. Why? Because it's a good technique to be able to determine whether or not you're going to have enough money. So here, I'm going to start with the assets on this side, and then you get liabilities and equity on the right side. But if you notice, I've got these percentages next to the current assets, and I've got percentages next to the current liabilities. These are known as variable assets and variable liabilities. What does that mean? Well, they tend to expand and contract with the sales value. When I have more sales, I have more cash. When I have less sales, I have less inventory. That's kind of the way it should work, is that these should expand and contract as this number moves, right? They're kind of variable that way. They're connected to sales. Not true about fixed expenses. They take a management decision. Am I going to buy something? Do I need something? That only happens when I make the decision to. Same thing over here with your long-term debt Is it only we take that on, we make the decision to, not because we sold more. If you notice for this example, I use 0 as notes payable. And I did that because this is their line of credit, but I've got it at 0 because it will show you, because the balance sheet has to balance if we need more money. In your company, you might already have a balance on your line of credit. Just know it will be the difference. I use 0 because it makes it easier for you to see for the example. So in this case, 116 is 4% of sales, 685 is 23, 1.2 million is 41%. That's kind of where it starts. So now I take those percentages and say, if I run the business exactly the same way as I did last year in 2021, this is what it should look like at the end of next year. So I'm going to project out. I'm going to take our 31 and I'm going to project out. We're going to do 323 in net profit. So if that's true, cash should be 4% of 3 million. In that case, it's 126,000. And then accounts receivable is 23%. Right. And then inventory should be 1.2 or 1.3 million. It should be 41%. All I've done is take my projected sales and try to structure what I think my balance sheet is going to look like. Now, this is as simple as working this down into a U, right? And back up. So we're going to go down the asset side, over to liabilities and equity, and then back up. That's how you forecast the balance sheet. So 126, 724, and 1.2 million gives us total current assets of 2.1. And I already had equipment and I already had leasehold improvements on the balance sheet, but I also showed you in the cash budget, I was going to do technology upgrades. I was going to buy some real estate, maybe new trucks. So I've got some new spending that I need to add in here. So not only did I project it in the cash budget, I'm also projecting it onto the balance sheet because it's going to expand the balance sheet. And it's about $760,000 that I wanted to spend over the next year in just upgrading equipment. So I take 2.1 plus 1 plus 4 plus 7 gives me 4.4, right? So 4.4 million is my total assets now with the new spending. Now, if that's true, the balance sheet's got the balance. So I take the 4.4 million and I just move it over to here. That's where I'm going to work it backwards, right? To determine, does the balance sheet balance? Because it's supposed to, right? It's supposed to be in balance. So this is the hardest part about projecting the balance sheet. You have to take the equity of last year and add in the net profit that you think you're going to make this year, right? That would be your retained earnings. That's going to how the retained earnings is going to expand. I'm going to take last year's equity and add in this year's projected net profit. So I got last year's equity of 1.4 million. I'm going to add in 323. So my equity should be 1.7. So now I'm working it backwards. I can just subtract because we know total liabilities and equity is 4.4. If I subtract equity, that means my total liabilities should be 2.6. And then I'm just going to keep long-term debt the same. If it changes, if we took on notes, we could, but I'm just going to keep it the same for the example. 5.9 or 599 from 267 means I should have current liabilities, variable liabilities of $2 million. Now, I should know the percentages of my payables and accruals, 16% and 35%. Let's add those back in. But I didn't have any line of credit, so I'm not expecting any this time. So if it balances, 1.1 plus 5 should equal 2. It doesn't, right? That's 1.6. That's 1.6 million. We're looking for 2, so the balance sheet doesn't balance. In order to make it balance, we have to add something to it, and that's the new capital. This is saying you can grow to 3.1 million. You're just going to need more money. The way you currently run your business, you're going to need more money. Now, this is where a cash flow expert comes into play. You're like going, well, before I go get a loan for $473,000, maybe I should run the inventory down. Maybe I should see if I can collect a little faster. Maybe I should see if I can pay a little slower. You have some levers to pull before you go make the loan request, right? See if you can move one of these 3 levers. In this case, I'd probably start with the inventory. But that's looking at the balance sheet saying, yes, you can grow this much, but you're going to need more money, right? We're going to have to get it from somewhere. It's going to come from the investors, or it's going to come from a loan, or we got to change the way we run the business. But this is the advisory services that you can be providing to your client on a regular basis. So in that book, that PDF book, if you email me at and I'm not going to go into it today because it takes a little bit longer. I've got 3 calculations that go after this. You're like going, well, how much can I grow? I have sustainable growth rate calculations that will tell you one of 3 things. You can grow and maintain the same level of debt to equity ratio, which means I'm okay taking on a little bit more debt, just not a lot, just the same amount in proportion. So my risk for debt is where I'm comfortable today. Or I'll take in the max debt that I think the bank will give me, which in most cases is 2.5 debt to equity ratio. So it will tell you how much you can grow if you take on the maximum amount of debt that the bank will give you. Or some of us will go, how much can I grow without taking on any debt? Well, there's a calculation for that too. It tells you how much you can grow the rate without taking on any more new debt. And using these calculations are so much better than just going, I'm going to grow 10%. Well, maybe you should only grow 7.4%, right? So this puts you in a better position where you're not making a decision from a guess that ultimately hurts your company. It puts you in a position where you're actually making a more methodical decision based on the data of how your company runs. So in this case, this company has a financing need of $473,000 that you as the advisor should be looking at the 3 levers, inventory, AR, AP, see if we can make adjustments to those and get this number down. So you want to learn more about what I do at the Clear Path to Cash or becoming certified as a Clear Path to Cash professional, go check me out at cashflowmike.com. I do have a free ebook, so you can get 2 today, right? The 7-minute conversation or forecasting by the numbers. I got a free Facebook group that I give away, different worksheets, spreadsheets, things like that. Lots of information. It's called the Clear Path to Cash. It's right in Facebook. I've got a podcast called Mike and Blaine, where my partner Blaine Birch, who is the founder and CEO of Dry Run Forecasting Software, it's called Business Beer and BS. If you like lighthearted, kind of like conversations, you can come there. Or if you want just more information about anything, you can contact me at Mike at Cashflow Mike. So I appreciate you. And I got a question. And AP and accruals also calculated as a percentage of sales. KC, yes. Right. So what you do is it's the same thing. It's called a variable liability. Just like the variable assets, you're going to do the same thing for the current liabilities, not get into the long-term stuff, but the current liabilities are also variable. They can expand with your sales. That's pretty good. So if you haven't already, please click the link, vote for me for best brand of the year for entrepreneurs. I'd appreciate it.
All right. Well, thanks so much, Mike. That was great. And everyone also, thank you for taking some time out of your day to hang out with us. And right before we close out this webinar, remember that we have a variety of webinars for you every month. And you can check out those out on our educational webinars page. And do not forget to check out and subscribe to our newsletter and YouTube channel. So do not miss out on news and updates that impact today's accounting professional. And also, a lot of people are saying thank you, Mike.
Yeah, that's good.
All
Appreciate you.
right. Yeah. Well, thanks for today, everyone. And we'll see you again in next month's session of Cashflow Mastery Talks with Cashflow Mike. Have a good day, everyone. Bye.